speed in on both units, and action.
Hello. Today we're going to talk about accounting transactions and how they impact financial analysis, meaning ratios. Ratios such as the current ratio, which you'll remember is current assets over current liabilities. Working capital, which you'll remember is current assets minus current liabilities. The debt to equity, which is total liabilities over total shareholders' equity, and earnings per share, which is your net income over the number of shares outstanding. We'll also look at if it impacts net income, then it'll be in the earnings per share, won't it? So let's look at the first one, and these all have to do with shareholders' equity kinds of transactions. So what if we were to issue common stock for cash? Well, we know that that is debit cash, credit common stock. Now, cash is a current asset, and common stock is a stockholders' equity account. So there's no impact on net income because it doesn't show up on the income statement. Current ratio, well, our cash is increasing, so the numerator of the current ratio is increasing, so that must mean the current ratio is increasing. Working capital, current assets are increasing, current liabilities don't change, so again, that will increase. Debt to equity, since we have stockholders' equity going up, that means the denominator is getting larger. The numerator, total liabilities, didn't change, so that means that ratio would decrease. And finally, since we didn't touch net income, earnings per share, no impact. Second entry that usually has to do with stock is the declaration of dividends. Now in this case, we're declaring, but we did not pay the dividend. So you'll remember that's debit dividends, a contra shareholders equity account, and credit dividends payable, a current liability. Now since neither of those has to do with net income, there's no impact on net income and there'll be no impact on earnings per share. But since our current liabilities are increasing, remember dividends payable is a current liability, that means our denominator, current liabilities, is increasing, current assets didn't change, so the current ratio decreases. Working capital will also decrease, and because current assets minus an increase in current liabilities would be a smaller number. As far as debt to equity, our liabilities are increasing and our stockholders' equity is decreasing. Because remember, stockholders' equity is dividends, dividends payable is the liability. So overall, since both the numerator and the denominator are decreasing, it causes, and it feels funny, an increase in the debt to equity ratio. And finally, when you pay a dividend, that's when you're debiting a current liability or making the current liabilities go down, and you're also crediting cash because stockholders do like to be paid cash for their cash dividends. So if that's the case, there's no impact on net income, so there's no impact on earnings per share. So let's see, cash is going to be going down, current liability, dividends payable is going to be going down. So that means that the current ratio will increase. Working capital, since they're going proportionately down the same amount, no change there. Debt to equity, our liabilities, dividends payable is decreasing. So the numerator's getting smaller, so that means debt to equity will also get smaller. So these are the transactions that could impact these ratios that generally have to do with liquidity or solvency or profitability, and what their impact is, because we had things going on in the business. Thank you.
Good job.